Anthropic's last round was done at what, $180+ billion value.
Hey, isn't it great that today we don't have someone doubting?
If you are Anthropic or you're OpenAI, you just need to try and get a hold of as much compute as you possibly can. You can't use your own credit rating to do it. No. You've got to tie yourself up to others. And so that's how you do it. It's the same way with, OpenAI and Oracle. OpenAI is using Oracle's credit, basically, to then help it secure compute to the tune of paying Oracle $60 billion a year for 5 years to access that Oracle will then build. By the way, there's a lot of other financing that's got to come into this entire ecosystem. Including from private credit. You've seen that deal, for example, the Hyperion deal. I talked about it a lot down in Louisiana for Meta, where Blue Owl is the lead. PIMCO is in there for a huge amount. BlackRock is in there.
Why would Blue Owl take that deal? Meta is the winner in this joint venture. Did you see this thing?
Blue Owl's taking its money, putting it in, and getting Meta credit and getting a return of 7%.
This deal's not wise.
Why?
Why?
Yeah, Meta is the ultimate credit here because you're betting on them using your data centers.
Blue Owl own 80% interest in the joint venture, and it's a pro rata share of the $27 billion goes to Blue Owl. 80%.
That's
not wise.
Why though? I don't understand, because they're getting paid 6-7% on that a year, and it's Meta. Is Meta going to go out of business?
Meta's good credit.
So why wouldn't that be a good credit? And why wouldn't that be a good deal?
It's a big outflow.
It's just big. By the way, the point I've made numerous times and will continue to is the CapEx is vastly understated, because this is not CapEx for Meta, even though it's all compute for Meta.
Absolutely. I thought that Meta got it. Look, all I'm saying is I thought Meta got a better deal than Blue Owl, but they've already sunk money into it.
Yeah, but it's a way for Meta to keep it off its balance sheet.
Why did you get the wise thing?
Excuse me?
Blue Owl.
Oh, wow. Because you just moved too fast for me, Jim. You moved too fast.
Carl, I try to provide some amusement. All he wants to do is get Zaslav $33.
So underappreciative.
Some levity, you're trying to be risible.
Something exciting, something tonight. Yeah.
That I got.
Thank you. Euro. Good.
To your point, though, I mean, Goldman's had some charts out this week looking at how they argue the hyperscaler spend is sustainable because it's not really debt heavy at this point.
Well,
it's mostly out of earnings, out of cash.
Except for OpenAI. I mean, when Hawk Tan, do you think he's like a made-up guy?
No,
he says he's going to get paid.
Not at all. Of course, I know that. But
when you go to
Carl, to this point about equity, I think it's a fair point on equity, but there is a lot of debt that's underlying this as well.
Yes,
and private credit is coming to the aid here of the bill. I mean, it's everything.
But yeah, by the way, B of A takes OWL off of its US 1 list today.
That was part of my
interesting.
Zeitgeist.
And then the Journal did this take on circularity. I don't know if you saw this graphic. Yeah. John Weil had a great piece arguing that when these things work, they work for a while, but when they stop working, you can see these are supplier agreements, financing agreements.
Can I just say that what people are implying is what's known as lazy Susan, which is against the law. You give me money, I give you money back. That's against the law. InfoSpace did that, okay? The first $1 trillion company.
It's not quite vendor financing. It's a bit different, but there's similarities to it. What's your point?
Only one. OpenAI is doing it, but Sarah Frier is the CFO. I have tremendous admiration for her. She's not going to do something that I think is reckless, but Sam Altman does have the too big to fail ally. Andrew Ross Sorkin had him on last night, 29, like the book.
Meta partnering with Blue Owl Capital on a $27 billion joint venture agreement to fund and develop the company's massive data center in Louisiana. This move comes just weeks after Meta announced a deal with CoreWeave for up to $14.2 billion worth computing capacity. Now, CoreWeave notably rents NVIDIA chips to power that cloud infrastructure. This is just one example of the tangled deal-making web happening across AI with chip makers, cloud providers, startups all intertwined, and let's not forget the financiers as well. Should investors be concerned that the circular spending might be the first sign of a bubble in space? Well, joining me now is Bradley Tusk, founder and CEO of Tusk Venture Partners. Great to have you on. And let's start right there and have you weigh in on this notion of whether this is getting bubbly or not.
Yeah, I mean, I think, look, I assume that when these companies say we need to invest $10 billion, $100 billion, $500 billion into infrastructure for AI compute and the energy for it, that they're not just throwing away the money for no reason. They truly believe that for the various plans they have to come to fruition, that amount of compute is necessary, that amount of data centers are necessary. So if we assume that's true, the challenge that we run into is it's still quite risky, right? Because you have effectively about a dozen companies that are driving the market today, spending incredible amounts of money, taking out incredible amounts of debt. And it is risky because if their perceptions of what's needed turn out to be wrong, or if the timeline is different or anything else, to have only a handful of companies effectively holding all of the upside and all the downside is a lot. And I think there's a revenue source that isn't being talked about, but should be. So when President Trump did his trade agreements with a bunch of different companies, some of them had components that included foreign investment in U.S. technology and the U.S. tech ecosystem. That includes UAE, so it's 1.4 trillion, Japan 550 billion. Why don't we start including them in these deals and start spreading out the risk so it's not all on American companies, all not ultimately on the American economy and American consumers? And there's precedent. There are countries that have been good partners over time. So like take the UAE, they've done a lot with us on nuclear, a lot on defense tech. So we know we can work with them. And this may be a little bit of a crazy idea, but I would love to get to a point where we're not only accessing these countries for capital they've said that they want to put into the US tech system, but we almost create like an axis of good on AI. Who are the countries that are really valuing innovation and investment and sensible regulations, which means not, a centrally controlled system like China, but not also as hands down as the EU, and use that to create a world of AI that solves massive global problems, whether it's decarbonization or drug formation. I think there's a tremendous amount of opportunity here. And I think because everything is so frenzied, we're not necessarily looking at it.
I think it's such a key point that you're raising, especially as we do have Korean officials, according to reports in Washington this week, to try and hash out a trade deal with Korea that includes potentially investment into this country as well. It gets at, I guess, a broader topic, and that is the role that policy plays in all of this, especially if you start to look at this AI buildup globally through a geopolitical lens.
Yeah, sure. Look, there are countries that clearly want to do these deals with the United States. They seem to be the same kind of countries that are generally very interested in building their own AI infrastructure because you need it for your economy and you need it for national security, and that's only going to grow and grow. And so, to me, let's not just make these all a bunch of random one-offs in different trade deals. Let's put it all together, put the capital in front of the U.S. companies taking on all of this debt and all of this risk. Aim it with a bunch of different policy things around AI regulation, around, what can we use to really solve really big problems. And then the third thing I think that I didn't mention before is we also need to keep seeding a lot of money into the early stage of the U.S. tech world, because yes, it's great that we have these dozen or so companies that can do really well already if they have what they need, but every company eventually gets stagnant one way or another. And if we have 10,000 or tens of thousands of earlier stage tech startups using AI to try to achieve different types of, different types of goals, create different types of companies, services, products, everything else, among those are going to be the next NVIDIAs, Googles, Amazons, whoever else. And so, yes, it's great to build all this infrastructure and capacity, but you need users for it. That's how you prevent a bubble from bursting. And I think in ways, I would take some of that money from Japan or Korea or the UAE or wherever and say, here's a dedicated fund to really invest in all kinds of interesting early stage US tech companies that can help ensure that there is demand in the future after all this stuff is built.
Alphabet today unveiled a new quantum chip, Willow. How is quantum computing going to fit into all of this as well? And I ask that knowing that I'm finding myself increasingly having conversations about the fact that the promise of quantum computing is going to come faster than everybody anticipated.
Yeah, that's definitely possible, and there's good and bad to that, but overall, more good. I mean, generally speaking, the more that we can solve really complicated technical problems and put them to actual use in the economy and in the world, that's a good thing to have. It might increase ultimately some of the infrastructure costs even more because obviously operating quantum computing is incredibly intensive, especially on energy. At the same time, there is also a world where between quantum computing and AI, you figure out ways to do AI that might not require as much compute and might not require as much energy. So perhaps, in a way, by bringing them into existence, we then develop the tools to actually solve the problem.
So you've broken this down, right? Because again, 2025, the year humanoid robots, and you say really the key has been three major breakthroughs.
Yeah, so we really see 2025 as the year of the robot. If we think of 2024 as the year of the agent, where all these technologies went into pilot mode, today we're seeing them in production. This is what we're seeing happening with robots. This is physical AI. This is the next wave of AI. And 3 technology breakthroughs, as you say, have converged to make this possible. The first is around the vision transformer. We saw a major breakthrough in 2024. This means that robots can now finally see. The second is around synthetic data generation. Because if you think about a robot, if you want it to put milk in the fridge, you've got to train it on an awful amount of data. And it turns out there's not enough real-world data in the world. So the key unlock was about this time last year, realizing that these models, in terms of the quality of the output trained on synthetic data, these are on a par, if not superior, to training these models on real-world data. And then finally is around reinforcement learning. So this used to be done by armies of human data labelers. Now it's being done by AI with humans in the loop. So this massively collapses the iteration cycle.
Another thing that you've written about recently is replicating human dexterity. And we just had Coyd out here. Pretty nimble. I mean, he runs better than I do, and I got bad knees, so listen. I ran better than him when I was 20, okay? I'm just letting them for the record. Let's talk about that for a moment.
Sure. So today's robots, they've got 2 things, both agency and dexterity, which enables them to perform pretty simple tasks. Now, this is what we call sort of a level 2 type robot. In order to reach level 3, we need to go one step further and enable mobile manipulation. And the way to do this, to improve dexterity, is to both increase the amount of compute. A rough rule of thumb is if you 10x the amount of compute you use to train these models, reinforcement learning, right, you double the intelligence. Right. And so we're going to move from vision transformers to hearing a lot more about VLAs, which are vision language action models. But then also in terms of the dexterity, it's improving the quality of the actuators, which actually allow the robot to move. These are the equivalent.
Elon Musk recently talked about the thumb being an issue. Is that the last hurdle, so to speak?
The hand is certainly one of the most complicated parts, because you think about all of the muscles and joints that you've got in your hand. It's probably where we've got I'm no medical practitioner, so I could get this wrong, but that is where you have a lot of complicated physics, right, that needs to be simulated and replicated in humanoid form.
Claire, we're running out of time, and we had a lot of questions for you, so I want to take at least one from the audience. Can we take a question here? I think we have Sandro.
Right here.
Hey, how you doing?
Hi, Charles. Hi. When will we know? When AI is going to be profitable in robotics and autonomous vehicles? How long is that? How long is that road?
It's an excellent question, and autonomous driving is certainly the first scaled use case of physical AI robotics. We think we're going to start to see meaningful strides next year, because what you see with all these technologies is that you require scale in order to bring through profitability. So at the moment, if we take a Tesla, it's fully self-driving capabilities, we're still on a per mile basis costing above $1. As you scale these fleets, we think you've got line of sight to 50 cents within 2 years, and ultimately reaching 30 to 40 cents with the Cybercab, which will be purpose-built for autonomous driving. So without the brakes, the steers, the pedals, and so forth. Now, the key with autonomous driving is really twofold. Certainly on the economic side of things, you want to be adopting, in our opinion, a vision-only approach, because just using cameras on the car, which is what Tesla does, it's a hardware cost of $400 or so. If you take a Waymo approach, it's got very expensive LiDAR and radar, that hardware cost is significantly more. We're talking north of $1,000. So Tesla can build a car, an autonomous driving vehicle, in the range of 25 to 30K. Waymo costs about 175K.
Wow, that's a distinct advantage for Tesla.
Absolutely. Well, the other key one is using an end-to-end neural networking approach. So almost every single other autonomous driving company is using still what we call deterministic software, software 1.0. So you have to hard code for every single corner case. And this is exactly where we're seeing disruption happen right now in enterprise software. We're moving to software 2.0, which is neural networking. So an AI model embedded into the software capable of deciding the best course of action by itself. And the main point, which we think everyone is underestimating, is when you adopt a neural networking approach end to end, this can enable exponential growth because it's self-learning. So Tesla ripped up the playbook about 2 years now ago. They were using a deterministic software approach. Their autonomous driving vehicle software was getting better at a rate of 2 to 4-fold every year. It's now getting better at a rate of 5 to 10-fold every single month.
So, Claire, that explains why Tesla commands such a high multiple, because what you said, if that's the case, maybe the stocks should be even a lot higher. Thank you very much.
Everything is a little bit speculative on the whole AI thing. You're assuming that you're going to get all the deliverables on where all this money is going and all the power that's needed, and at some point the record may skip.
Not when you look at backlog up 15% at GE Vernova at $135 billion. That's real money. That's real orders, right? So to me, the backlogs are the most important. Company commentary is extremely important, and they both were very positive. And so if they pull back because they've run a bit, that's your opportunity.
So I did some work a couple weeks ago on this exact point, which is the stocks that end up beating earnings go up more than 10 days before the print than they do the few days after. So if you're a real investor like these guys, they're not buying it just for the print. They're buying it because they think it's structurally going to go up and beat and raise multiple times. So that is a pretty common pattern where, companies don't react as well. That certainly happens. The second thing I'd say is back to what I've said previously, like you were like, is Tesla and NVIDIA the two winners from AI? I disagree with that. And it's been in my head, so it's been bothering me, so I don't know if I'm hijacking where you're headed.
It doesn't matter, go ahead.
I'll take NVIDIA and Taiwan Semi all day long. And I think that Taiwan Semi is the most important asset on earth. Personally, and if I'll take a power name too. She listed a bunch that I like, but I'd probably take, if you're saying this is happening and I think a company can be 5, 10x bigger, I'll probably go CEG. I'll probably take Constellation. So I'll take CEG, Taiwan Semi, NVIDIA. I think I like that cocktail better than Tesla, but I don't. Problem I have with Tesla is it's impregnable to analysis, and that's never my strength.
I had a fund manager text me during the conversation and say the notion that they're going to have 80% of the autonomous market is ridiculous. So I mean,
I'll take the under on that. But what these guys could be right about is who knows where it's going to trade in a 3 to 6 month view. Every hedge fund guy I talk to all the time has lost money shorting it 17 times in the last 10 years for reasons that have nothing to do with how it trades. So it's kind of impregnable to research at this point, and you're dreaming on 20, 35 humanoid volumes or whatever. So I'm not saying good or bad, but I know what Taiwan Semi does, and I know it can't be replaced.
All right, I hope you're all doing well today and staying calm in this market. Today was a notable red day throughout much of the market. A lot happened today. The market was already moving lower today when a Wall Street Journal published a report saying the administration is considering export controls on a wide range of products to China that rely on U.S. software. It's worth bearing in mind that the leaders of both countries are supposed to meet soon. And so perhaps this is just more of the back and forth tensions as both sides try to gain additional leverage ahead of that meeting. Also today, both Vertiv and GE Vernova reported very strong earnings, which bodes well for NVIDIA, as both of those companies are central to the build-out of AI data centers. Unfortunately, the stocks of both Vertiv and GEV finished the day lower despite reporting strong results. Also today, Google announced a major quantum breakthrough. Google says it's developed a new quantum computing algorithm called Quantum Echoes that runs on its quantum chip Willow. Google claims the algorithm delivers a 13,000 times speed up compared to the best known classical algorithms on supercomputers. Google says it achieved the first verifiable quantum advantage, marking an important step toward real-world applications for quantum computing. Speaking of Google, NVIDIA's Jensen Huang is scheduled to sit down with Google Cloud CEO Thomas Kurian for a fireside chat on October 29th starting at 9 a.m. Eastern. And on that note, we have NVIDIA GTC in Washington, D.C. next week with a keynote from Jensen Huang scheduled for October 28th at 12 p.m. Eastern. Previously, NVIDIA had the keynote scheduled for 10:30 in the morning, but now it is scheduled for 12 p.m. Eastern on October 28th. Be on the lookout for any announcements of sovereign AI initiatives with the U.S. government or large-scale projects with U.S. companies. During GTC keynotes, Jensen usually announces large-scale projects that are unique to the region where the GTC event is being held. And this event is being held in Washington, D.C. Really quick, I want to briefly address Iron and say that my conviction in the company has not changed despite the stock getting hammered in recent trading sessions. Iron has been trading lower recently mainly due to issues that are completely unrelated to Iron. Unfortunately, Iron has been lumped into the same basket as many of the high-flying speculative stocks that have no earnings and in some cases no revenue. And Iron has recently been trading lower with that group of stocks. Additionally, the recent news about BC proposing a rule change regarding how electricity is allocated should have no meaningful impact on Iron, as I explained in yesterday's video. And so the stock trading lower on that is the wrong read of the situation. And then last week we had that FT article insinuating that renting GPUs is a horrible business and the AI bubble is going to pop. But as I discussed in a recent video, the math in that article was incorrect by a factor of 8 despite the writer's claims otherwise. It turns out renting GPUs is not such a bad business when you use the correct math. And we've also had the back and forth trade tensions between the US and China weighing on stocks. And again, that is another issue that has nothing to do with Iron. All of that to say that the recent pullback we've seen in Iron does not concern me. Nothing has fundamentally changed about the company, and I'm viewing this as a long-term investment for at least the next 1 to 2 years. Short-term price action in the stock does not change the long-term fundamental trajectory of the company. I continue to be bullish on Iron over the next 1 to 2 years, and I think we may get a nice opportunity to responsibly add to long-term positions on this pullback. This is not financial advice, and I encourage you to research Iron. Now going back to NVIDIA. After GTC this month, we have hyperscaler earnings with Alphabet, Meta, and Microsoft all scheduled to report earnings on October 29th, and Amazon reporting the next day on October 30th. All eyes will be on these companies' CapEx guidance and CapEx commentary on their earnings calls. What these companies say about CapEx will have an important impact on how NVIDIA trades in the short term, so be prepared for that later this month. Here is where these companies' CapEx guidance stands as of their most recent earnings reports. Alphabet last raised their 2025 CapEx guidance to $85 billion. Meta last raised their 2025 CapEx guidance to the range of $64 to $72 billion. Amazon spent $31.4 billion on CapEx in the most recent quarter and indicated that that amount is representative of their quarterly CapEx through the remainder of the year. And Microsoft told us they expected to spend well over $30 billion on CapEx in the quarter they will be reporting later this month. Microsoft told us that CapEx will grow at a slower rate in fiscal 26 as they shift their spend toward more short-lived assets inside the data centers, such as CPUs and GPUs. Last earnings call, Microsoft CFO said that they were still capacity constrained. And now, let's see what commentary we get around that subject this earnings season. If Microsoft continues to be capacity constrained, that bodes well for NVIDIA as it indicates demand is still very strong. I continue to be bullish on NVIDIA long term, and I seriously think this company has plenty of runway ahead of it. I don't think we are anywhere near any type of bubble bursting type of event, and I think all of the hyperventilation about an AI bubble at this point is largely overblown. I also think that most analysts are substantially underestimating NVIDIA's long-term growth. That's one of the reasons I keep talking about this company. I'm serious when I say that I think most analysts are underestimating the growth ahead. Of course, I expect NVIDIA's data center business to continue growing, but I think most analysts are substantially underestimating some of NVIDIA's other business segments. I am completely serious when I say that I think NVIDIA's physical AI business may eventually be larger than their current data center business. We're no longer talking about AI agents completing digital tasks. We're now talking about physical AI agents completing physical tasks in the real world. This is going to fundamentally change society, and physical AI represents a massive growth opportunity for NVIDIA. NVIDIA is actively establishing themselves as the indispensable foundation of physical AI. NVIDIA sells the hardware for the data centers where the models are trained. They offer Omniverse where the models are taught and tested. And NVIDIA also sells the hardware that allows on-device real-time inference through NVIDIA AGX, allowing robots to have intelligent interactions with the real world even when they are not connected to a data center. Again, this is a massive long-term growth opportunity that does not get enough attention. In addition to physical AI, we also have quantum computing. Jensen told us earlier this year that NVIDIA is already working with just about everyone in the quantum industry on NVIDIA's CUDA-Q platform. Jensen also told us that the next generation supercomputers will have a QPU assigned with QPUs connected to GPUs. Just as NVIDIA used their GPUs to speed up CPUs, they're now going to do the same thing with QPUs. Again, this is another large long-term growth opportunity that does not get enough attention. The next time you hear someone worried about NVIDIA being a bubble, remember that we are still in the early stages of AI, and we are still in the very early stages of both physical AI and quantum computing. Both of these emerging industries will increase the need for more compute. In addition to those two opportunities, NVIDIA has other large growth opportunities that they are really just starting to capitalize on in a meaningful way, including sovereign AI, enterprise AI, and many AI native startups. These growth opportunities will also increase the need for more compute. As for production ramps, Blackwell Ultra is ramping very quickly right now, leading to revenue growth acceleration. Rubin is on track to launch in 2026. Then we're expecting Rubin CPX at the end of 2026. Later on, we're expecting the launch of Rubin Ultra in 2027 and Feynman after that in 2028. We have a clear data center product roadmap stretching into 2028, and Jensen believes there will be $3 to $4 trillion of global AI factory build-out between now and 2030. That means Jensen is expecting growing AI demand and an expanding total addressable market underpinning all of this. I don't think we are anywhere near any type of bubble bursting type of event. With all of this in mind, I seriously think that NVIDIA still has plenty of runway ahead of it, and I think this company will be worth substantially more in future years than it is today. At least that's my view of the situation. Remember to stay calm in this market. Remember to maintain a long-term perspective, and do not make any hasty or irrational decisions. With all of that being said, I hope you all have a great rest of the day, and I'm curious to hear your thoughts about NVIDIA in the comments below. Please leave a like on this video so more people will see it. And while you're down there, please consider subscribing. It's free, and you can always change your mind. Thanks for watching, and hopefully I'll see you in the next video.